I feel like usually when we talk about numbers, especially hard numbers like corporate revenue, there is this underlying expectation of just absolute precision.
Oh, absolutely. People assume it's black and white.
Right.
I mean,
Like you think of it like looking at an X-ray of a broken arm. You put the film up to the light and boom, there it is. A clean, unambiguous fracture.
Exactly.
You check a company's bank account, right, and a deposit clears for $1 million. And you just expect the accountant to point at the screen and say, well, there it is, $1 million in revenue.
Yeah, it's a very common assumption. I mean, people want financial health to be binary. Cash is either in the vault or, it has left the building.
Right. But the moment you actually step into the mechanics of corporate revenue recognition, especially when a company starts throwing complex customer incentives into the mix, you realize that X-ray analogy just doesn't hold up at all.
It really doesn't.
Suddenly, you're not looking at a clean fracture. You are looking at shadows on the scan. You are looking at hidden fractures that, they might not break for another 2 years.
That is a perfect way to describe it.
The cash sitting in the company's bank account today absolutely does not equal the revenue they are legally allowed to claim on their books. So, welcome to a brand new deep dive on the Gap Advisors Ind AS Clinic podcast. We're going to explore exactly how those shadows on the financial scan are interpreted, looking at a highly relatable but honestly surprisingly complex corporate scenario, which is customer incentives. But before we get into the weeds, I want to establish our ground rules.
Yes, that is essential. So before we unpack the mechanics of these accounting standards, I just need to state clearly that the views expressed in this deep dive are the personal views of the author of the source material and are not binding on anyone.
Right.
You, the listener, are requested to seek the help of a qualified expert before taking or refraining from any action based on the views we discussed today.
Definitely. And keeping that in mind, I want to talk directly to you, the listener. Let's say you are an everyday investor, right? You are putting your hard-earned savings into the shares of a listed company. You might be listening to this and wondering, well, why do I need to care about the minutia of accounting standards?
Right. They think, isn't that the auditor's job?
Exactly. Isn't that why companies hire those massive audit firms? I just want to look at the top-line growth and make my trade. So why is it actually dangerous for an investor to ignore the mechanics we are about to discuss?
Well, it is dangerous because revenue recognition is, it is the absolute bedrock of a company's valuation.
Right.
It dictates the entire narrative of their growth. So if you don't understand the rules dictating how and, crucially, when a company records its revenue, you are fundamentally flying blind regarding their actual financial sustainability. Imagine a company that just decides to offer incredibly aggressive incentives to its distributors. Like they say, buy 50 units this month, and we will give you a massive future discount. Or, a luxury vacation, or even a bar of solid gold.
Which, honestly, sounds like a pretty great way to boost sales for the quarter.
Oh, it is. It's fantastic for sales, and the cash, it flows in immediately. But here is the trap for the uninformed investor. If the accounting standards didn't force that company to properly defer the revenue associated with those future promises, well, you would look at their quarterly income statement and see this spectacular booming enterprise.
And you'd probably buy the stock at a premium.
Exactly, you would buy in. But underneath that surface, the company hasn't actually earned all that money yet. They are sitting on a ticking time bomb of unfulfilled obligations. Vacations they have to pay for, gold they have to source and ship out.
Right.
If you just look at the cash in the bank, you are completely distorting your view of the company's actual liabilities.
So you think you're buying a ticket on a rocket ship, but you're actually buying the liability for like 1,000 future trips to Switzerland that the company still has to fund.
Exactly that.
That fundamentally changes how you look at a quarterly earnings report.
Yeah.
And before we introduce the specific facts of the case we are analyzing today, we should probably establish the global reach of this problem, because our response today is grounded in the Ind AS framework, right? The Indian accounting standards.
Correct.
But how relevant is this if our listener is, say, analyzing a company based in London or Singapore?
Oh, it is entirely relevant. For the specific topic we are dissecting today, there is absolutely no difference between Ind AS and IFRS.
Really?
None. The International Financial Reporting Standards, they are functionally identical to Ind AS in this context. So if you are an analyst or an auditor or an investor looking at an entity literally anywhere in the world that follows the IFRS framework, this deep dive applies directly to you. We are speaking a global accounting language here.
Perfect. So let's lay out the exact shadows on the scan we are trying to read today.
Yeah.
Because we pulled a very specific case from our source material.
Yes, we did.
We are looking at a manufacturing company that gives major high-value incentives to its B2B customers. They don't do, simple buy 10, get 1 free deals. This company offers a gold scheme alongside foreign and domestic tours.
Quite the incentive.
Right. But there's a catch that the customer only gets these incentives if they attain a certain, really high level of revenue within a specific time frame.
So we are dealing with conditional high-value rewards.
Exactly. Conditional. So picture a massive regional distributor. They buy heavy industrial machinery from the manufacturer, and the manufacturer comes to them and says, look, if your cumulative purchases cross 50 million rupees by the end of the year, we will send your top management a solid gold coin, and we will fly your sales team out on an all-expenses-paid foreign tour.
I mean, it is a brilliant strategy from a marketing perspective.
Totally.
It locks in loyalty, and it really pushes the distributor to aggressively sell the machinery just to hit that threshold. But from an accounting perspective, the moment that contract is signed, it creates 2 massive queries that the entity absolutely must resolve to remain compliant with the standards.
And what are those 2 big hurdles?
Well, the first is valuation and timing. How on earth is the transaction price calculated when the reward is conditional? And crucially, when does the company actually recognize the revenue for the machinery versus the incentive schemes?
Right, because it's all tied together.
Exactly. And the second hurdle is the mechanical reality of the ledger itself. Like, what are the exact journal entries? What gets debited and credited on the day the initial machinery is sold? And then what happens months later on the day the gold or the tour tickets are actually handed over to the customer?
Okay, to solve that, we clearly need a map. We can't just guess how to record a 50 million rupee machinery sale with a Swiss vacation mysteriously attached to it. The master framework governing this entire universe is Ind AS 115, right?
That's the one.
But before we get into the specific paragraphs and the tests, what is the underlying philosophy here? Because historically, accounting just looked at when the invoice was cut, didn't it?
Yes, historically, under older frameworks, there was this heavy reliance on the transfer of significant risks and rewards. And you're right, it often aligned very closely with the invoicing. But Ind AS 115, which is titled Revenue from Contracts with Customers, it completely shifted the paradigm.
How so?
The entire framework is built on one core principle. An entity shall recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services.
Okay, I really want to focus on that specific phrase. Expects to be entitled.
Yes, that's the key.
Because that implies we aren't just looking at the cash that changed hands today. We are looking at the economic reality of the entire relationship going forward.
That is the crucial distinction. And AS 115 is completely obsessed with economic reality over contractual form. So if you sell 1 million rupees worth of machinery today, but based on a mountain of historical data, that you are inevitably going to have to give back 100,000 rupees worth of gold coins at the end of the year. Well, your true economic reality today is not 1 million rupees.
Less.
Exactly. The standard forces you to look into the future, estimate that liability, and actually reflect it in today's numbers.
It's essentially forcing accountants to become behavioral economists.
It really is.
You have to predict what the human customer is actually going to do.
Oh.
And I assume to prevent that from turning into just pure guesswork, Ind AS 115 provides a system.
Yes, it provides a very rigid 5-step model that every single contract has to pass through.
Okay, let's unpack this. What are the 5 steps?
The 5 steps are non-negotiable. Step 1, you have to identify the contract with the customer. Like, is there a real, legally enforceable agreement with commercial substance? Step 2, you identify the performance obligations in the contract. This means looking closely at the deal and identifying every single distinct promise you made.
Okay.
Step 3, you determine the transaction price. So what is the total pie of consideration you expect to receive?
The expected pie.
Exactly. Step 4, you allocate that transaction price. You take the total pie and slice it up among all those distinct promises you identified back in step 2.
Right.
And finally, step 5, you actually recognize the revenue when or as you satisfy those individual performance obligations.
Okay, let's take that 5-step framework and drop our specific scenario into it. We have the heavy machinery, the conditional gold coin, and the foreign tour. Step 1 seems like a given, right?
Yes, very straightforward.
The manufacturer and the distributor have a clear, legally binding contract for the sale of goods, and the incentive scheme is explicitly written into the terms. There's clear commercial substance.
Correct. Step 1 is easily cleared. The real diagnostic challenge, the place where we have to start interpreting those shadows on the X-ray, it begins at step 2, identifying the performance obligations.
Because to the marketing department, this is just one big, sexy promotion, right?
Yeah.
Buy the machinery, get the gold. They view it as a single package.
They do.
But the accountant can't look at it that way. We have to tear the deal apart and see how many separate promises are actually living inside this contract.
Exactly. We have to deconstruct the bundle. And the framework gives us a very specific mechanism for doing this under paragraphs 22 and 27. We have to determine if a promise to transfer a good or service is, well, the word is distinct.
Distinct. Now, that sounds like a word two lawyers could argue over for a decade.
Oh, without a strict definition, they absolutely would.
So how does the standard define distinct so that we don't end up in endless subjective debates?
The standard does not leave room for casual interpretation. It provides a highly rigorous two-part test. And a good or service is only considered distinct if it passes both parts of the test simultaneously.
Okay, walk me through part 1 of the test.
So part A, under paragraph 28, is fundamentally about the customer's capability. The standard asks, can the customer benefit from the good or service either entirely on its own or by combining it with other resources that are readily available to them?
Right.
If the answer is yes, the item is capable of being distinct.
Okay, so let's apply that. We have the primary goods being sold. Let's stick with the heavy industrial machinery. Can the distributor benefit from that machinery on its own? Well, yes, obviously. They can resell it to a construction firm. They don't need the gold coin to make the machinery turn on.
Exactly.
So the machinery is capable of being distinct.
Precisely. Now, apply that exact same logic to the incentives. Can the customer benefit from the solid gold coin independently of the machinery?
Absolutely. The intrinsic value of gold exists regardless of what's happening with the industrial equipment. They could put the coin in a safe, they could melt it down, they could sell it on the open market for cash, they can realize economic benefit from it completely on its own.
And the foreign tour.
Same thing. The distributor sales team can board a plane, fly to Switzerland, stay in the hotel, enjoy the sights. The benefit of the tour, the travel and accommodation services, it just does not require the machinery to function.
Exactly. The source material points out a very helpful heuristic here. If an entity, or even another entity in the market, regularly sells that good or service separately, well, that is strong evidence that it is capable of being distinct.
That makes a lot of sense.
Right. Travel agencies sell tours every day. Commodity brokers sell gold every day. So without question, the machinery, the gold coin, and the tour all pass condition A. They are capable of being distinct.
Okay, that was the easy hurdle. But condition B is where it gets incredibly nuanced, right? Paragraph 29.
Yes. Condition B requires us to look at the entity's promise to transfer the good or service and ask if it is separately identifiable from other promises within the context of the contract.
Right, so condition A basically asks, could these things theoretically be separated in the wild? And condition B asks, did we actually separate them in this specific deal, or did we fuse them together?
That is the perfect way to phrase it. And the standard gives us 3 specific negative indicators to help us figure out if things have been fused together. If any of these 3 factors are present, the items are not distinct within the context of the contract.
What are the 3 factors?
First, does the entity provide a significant service of integrating the goods or services into a combined output?
Okay.
Second, does one good or service significantly modify or customize another good or service in the contract?
Got it.
And third, are the goods or services highly interdependent or interrelated?
I think an analogy is the best way to make these 3 negative indicators concrete for the listener. So let's think about buying a car from a dealership.
Sure, let's look at a car.
When you sign the contract to buy a car, you are technically signing a contract that includes a promise for a V8 engine, a chassis, 4 tires, and a steering wheel. Now, under condition A, a steering wheel is capable of being distinct. You could go down to an auto parts store, buy a steering wheel, and benefit from it by hanging it on your wall or putting it in a completely different car.
True. That passes condition A easily.
But under condition B, when you buy the car from the dealer is providing a significant integration service. They're taking the engine, the chassis, and the steering wheel, and they are integrating them into a single combined output, which is the vehicle.
Exactly.
Furthermore, the engine and the transmission are highly interdependent. The transmission is absolutely useless without the engine to drive it. Because of that massive integration and interdependence, you do not account for the sale of the steering wheel as a separate performance obligation from the engine. It is all fused together into one single performance obligation, delivering a functioning car.
That perfectly illustrates integration and interdependence.
They-
Now, contrast that with a different retail scenario.
Okay, imagine you go to a big box electronics store. You buy a high-end laptop. The store is running a promotional deal where anyone who buys that laptop gets a free wireless printer.
Okay, let's run the test on that.
Right. Condition A is the printer capable of being distinct. Yes, you can use it to print documents from any device, not just the laptop. Condition B, are they distinct within the context of the contract? Well, is the store providing a significant integration service? No. They were literally just handing you two separate boxes. Does the laptop significantly customize the printer? No, it's just a standard off-the-shelf printer. Are they highly interdependent? No. You can use the laptop without ever taking the printer out of the box, and you can use the printer with a completely different computer. There is zero transformative relationship. They're just two items sitting next to each other in the shopping cart.
Exactly. And that is exactly how we must analyze our source scenario with the machinery, the gold, and the tours. We look at the contract. Is the manufacturer taking the heavy machinery, the solid gold coin, and the plane tickets to Switzerland, and integrating them into some kind of hybrid mega product?
Unless they are building a gold-plated tractor that can only be driven in the Swiss Alps, the answer is definitively no.
Right. There is no significant integration service. Does the gold coin somehow modify the software of the machinery? No. Are the plane tickets highly interrelated with the mechanical function of the equipment? No. There is zero transformative relationship between these three items.
So, by rigorously applying the logic, we have completely untangled the marketing department's bundle. We don't have one single transaction. We have definitively identified three entirely separate performance obligations.
Yes, we have.
Number one, the promise to transfer the machinery. Number two, the promise to transfer a gold coin. And number three, the promise to provide tour services.
And arriving at that conclusion is what fundamentally dictates everything that follows. Because now that we know we have three separate buckets of value, we have to figure out how much revenue actually goes into each bucket.
All right, so we have transitioned from identifying the promises to pricing them. We are moving into steps 3 and 4 of the framework, right?
Yeah.
Determining the transaction price and allocating it.
Right.
And this is where the math gets genuinely fascinating. Because we aren't just reading a price tag. The company promised the goals and the tours, but they attached a massive condition to it.
A huge condition.
The distributor only gets them if they hit the 50 million rupee purchase target. So what happens if they only buy 49 million rupees worth of machinery? They get nothing.
Nothing at all. And this is the crux of the entire accounting challenge. The total consideration the entity will ultimately receive, or the ultimate value they will have to deliver, is not fixed on day one. It depends entirely on the future behavior of the customer.
Right.
And the moment the consideration depends on a future event, we are dealing with what the standard, specifically paragraphs 47 and 50, calls variable consideration.
Variable consideration. And when you have variable consideration, you can't just wait until the end of the year to see what happens then. The framework doesn't allow you to be passive.
It explicitly forbids passivity. You must estimate the amount of consideration you expect to be entitled to right from the inception of the contract. You have to make a prediction on day one. Wow.
And the standard prescribes specific methods for making this prediction. When you are dealing with a large volume of similar contracts, like a promotion offered to hundreds of distributors, you are required to use the expected value method.
Okay, I really want to slow down here and build a concrete mental model for the listener, because the term expected value method can sound pretty abstract, but it's really just probability-weighted statistics, isn't it?
That's exactly what it is.
Let's create a hypothetical math problem to see how this actually works.
I think that's the best way to understand the mechanism. Walk us through one.
Okay, let's say our manufacturer is selling 1 unit of heavy machinery to a distributor for exactly 10 million INR. That's the cash price.
Okay.
But attached to that sale is the promotion. If the distributor hits their targets over the year, they get the gold coin and the tour. Now, let's say the company analyzes the market and determines the standalone retail price of that gold coin is 500,000 INR.
And the standalone market price of the Swiss tour is another 500,000 INR. So the total standalone value of the basket of goods is 11 million INR.
10 million for the machine plus 500,000 plus 500,000, yes.
But the customer is only paying 10 million INR in cash. Now, If the company assumed every single customer would claim the rewards, they would have to allocate a massive portion of that 10 million INR cash payment away from the machinery and into the liability buckets for the gold and the tour.
Yes, absolutely. If they assumed a 100% claim rate, the machinery revenue would be severely reduced on day one. But reality tells us that a 100% claim rate is virtually impossible.
Right. There is always friction. Distributors fall just short of the target, they lose the claim forms. Key sales staff leave the company, and the tour just gets ignored.
Yeah.
This is what we call breakage, right?
Yeah. Exactly. Breakage is the proportion of rights that the customer holds but will ultimately leave unexercised. So the company has to look at its historical data to estimate this breakage. They might find that historically, only 60% of eligible distributors actually hit the target and claim the physical gold coin.
Okay.
And maybe only 40% actually go through the hassle of booking the foreign tour.
So logically, if I'm the accountant, I don't value the gold obligation at the full 500,000 INR. I multiply it by the probability. So 500,000 times 60% means the expected value of that gold promise is only 300,000 INR.
Spot on.
And the 500,000 INR tour, at a 40% probability, has an expected value of 200,000 INR.
You have perfectly executed the expected value method. You take the range of possible outcomes, weight them by their probabilities, and sum them up. Now, instead of allocating the 10 million INR cash payment based on a total standalone value of 11 million INR, you allocate it based on an expected standalone value that actually accounts for human behavior.
Which means more revenue gets allocated to the machinery up front, because the company statistically knows they won't have to deliver all the gold and tours.
Exactly.
But wait, what happens if this is a brand new manufacturing company? Like, they just launched. They don't have 5 years of historical data to figure out that 60% probability. Can they just guess?
Absolutely not. They cannot just guess. If a company lacks its own empirical data, the source material is very clear. They must rely on representative peer data. They have to look at industry averages for similar promotional schemes.
But what if they get it wrong? I mean, what if they assume a 40% claim rate for the tour, so they recognize a ton of machinery revenue up front, but then suddenly the distributor has a massive year, hits all the targets, and demands every single ticket to Switzerland?
That exact scenario is why auditors lose sleep over variable consideration. If the company significantly underestimates the claim rate, they will have overstated their current revenue. And worse, they will take a massive unexpected financial hit in the subsequent period when they have to pay for tours they didn't properly accrue for.
Ouch.
To prevent this, the standard places a strict constraint on variable consideration.
Meaning you have to be conservative.
Highly conservative. You can only recognize revenue to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty is eventually resolved.
Okay, I see.
So if you don't have reliable historical or peer data, the auditor will force you to assume a much higher claim rate, deferring more revenue until the uncertainty passes.
That constraint makes perfect sense. It protects the investor from seeing artificially inflated top-line numbers. So we've done the heavy lifting. We identified the 3 distinct obligations. We mathematically calculated the expected value of the variable consideration based on empirical data, and we allocated the transaction price across the machinery, the gold, and the tours based on their relative expected values.
We have finally reached step 5, right? The ledger. We need to actually bring this to the books.
This is where theory turns into reality. Paragraph 31 of the standard dictates exactly when the accountant hits the button to recognize revenue. And the framework has a very specific rule for this moment, right? It's entirely centered around the concept of control.
Yes. The rule of transfer states that an entity shall recognize revenue when, or as, the entity satisfies a performance obligation by transferring the promised asset to the customer. And an asset is transferred precisely when the customer obtains control of it.
And control doesn't just mean it was put on a shipping truck, does it? It means the customer has the ability to direct the use of the asset and obtain substantially all of its remaining benefits.
Exactly.
So let's trace the timeline of our specific deal and try to deduce the journal entries. For everyone listening, maybe grab a mental notepad for this part.
Good idea. Let's start on day 1, the initial sale to the customer. The manufacturer delivers the heavy machinery to the distributor's lot. The distributor signs the delivery receipt. They now have control of the machinery.
Okay, logically, the manufacturer is now owed the 10 million INR we discussed earlier, so they need to record that receivable. I would guess the first entry is a debit to the customer account.
Correct. debit the customer account for the full invoiced amount. Now, what do you credit?
Well, they deliver the machinery, so I can recognize the revenue for the machinery, but I can't credit the full 10 million INR to revenue because part of that 10 million INR was effectively a prepayment for the gold and the tours that I haven't delivered yet. So I would credit revenue from sale of goods, but only for the specific mathematical amount we allocated to the machinery back in step 4.
Spot on. You only recognize what you have transferred control of, but now your debits and credits don't balance. You have a gap equal to the allocated value of the gold and the tours. Where does that go?
Right. I haven't given them the gold or the trip. I owe them an asset. So I had to park that money in a liability account. I would credit a contract liability account.
Exactly. Credit contract liability. And let's explain what that actually means for an investor looking at the balance sheet. Why is it called a liability when the company hasn't borrowed any money from a bank?
It's a liability because it represents an unfulfilled promise. It's essentially unearned revenue. The company has secured the consideration from the distributor, but they still owe the distributor a performance. That contract liability sits on the balance sheet like an anchor, representing a future outflow of resources, dragging down net assets until the promise is kept.
It is a perfect mechanism for ensuring the balance sheet reflects the true economic burden of the promotion. So, let's move the timeline forward. 6 months later, the distributor aggressively sold the machinery, and they officially crossed the 50 million rupee threshold.
Awesome for them.
They fill out the claim forms, the manufacturer sources the solid gold coin, hands it to a courier, and it is delivered into the hands of the distributor's CEO. Control of the gold has transferred. What is the entry?
Okay, the burden is lifted, the promise is fulfilled, so I need to pull that anchor off the balance sheet.
Yeah.
I would debit the contract liability account, reducing it. And because control of the gold is transferred, I can finally claim the revenue. So credit revenue from sale of gold.
Precisely. The liability drops, the revenue hits the income statement, and the accounting perfectly matches the physical economic event.
But here's the ultimate shadow on the X-ray, right? Let's look at the foreign tour. The promotion rules state that once the target is hit, the distributor has 90 days to book the Swiss tour. Day 91 arrives. The distributor was too busy, they never submitted the travel dates, and the claim period officially lapses.
It happens all the time.
The manufacturer is legally off the hook. They never have to buy those plane tickets. But the accountant still has a massive contract liability sitting on the balance sheet for that unredeemed tour. What happens?
This is the exact scenario of breakage realizing itself in real time. The source material dictates a very elegant solution for this. When the claim period lapses, the entity must extinguish the liability. So they debit the contract liability account.
Okay, but where does the credit go? They didn't provide a tour, so they can't credit revenue from tours, and they didn't sell any more gold.
They credit revenue from sale of goods?
Wait, really? It flows backward. They credit the original heavy machinery.
Exactly. Think about the economic reality of what just happened. The distributor paid the 10 million INR. A portion of that was allocated to the tour. But the tour never happened, and the company is legally relieved of the obligation. Therefore, the retroactive reality is that the distributor effectively paid that entire 10 million INR just for the heavy machinery.
Oh, wow.
The system self-corrects. The unredeemed value of the tour falls back into the original bucket, and the company recognizes the remaining revenue on the primary goods.
That is incredibly elegant. The standard dynamically adjusts the revenue to match the final realized behavior of the customer. But to fully anchor this in the real world for our listeners, especially those analyzing Indian entities or those operating across borders, we have to introduce two critical logistical variables, don't we? Timing and currency.
Yes, financial reporting does not happen in a vacuum. It happens within very rigid temporal and monetary parameters. Let's tackle currency first. For the entities we are primarily discussing under the Ind AS framework, their functional and presentation currency is almost universally the Indian rupee, or INR.
Right. And this creates a fascinating wrinkle when we talk about a foreign tour to Switzerland. Because any currency encountered outside of the functional currency, say the Swiss francs needed to pay the hotel, or the euros needed for the flights, well, that is classified as foreign currency.
Exactly. And this is where analysts need to pay close attention. The contract liability sitting on the company's balance sheet, the allocated value of the unfulfilled tour, was calculated in INR based on the original transaction price. It is what we call a non-monetary liability.
Right.
It's an obligation to deliver a service, not a fixed amount of cash. Therefore, under Ind AS 21, that liability is not constantly retranslated at the end of every month as exchange rates fluctuate. It stays locked at its historical INR value.
So the liability doesn't change, but the actual cost to fulfill the tour will change based on the exchange rate when the company actually buys the Swiss francs to pay the hotel.
Precisely. The revenue recognized when the tour happens will be based on that locked-in historical allocation, but the expense of the tour will reflect the live foreign exchange rate. If the rupee depreciates significantly against the Swiss franc before the tour is booked, the company's margin on that specific promotional fulfillment could be completely wiped out.
That is a brilliant nuance.
Oh.
It really shows how a seemingly simple promotion introduces FX risk that the accounting department has to manage. Now, what about timing? Because human behavior doesn't neatly align with corporate calendars.
The timing of these lapses, these probability adjustments, and these fulfillments must be meticulously tracked against the standard reporting period. For Indian entities, that period almost universally begins on the 1st of April and ends on the 31st of March.
And that boundary is critical, because if a distributor buys the machinery in February, hits the target in early March, but doesn't actually schedule the Swiss tour until May, that contract liability has to cross the March 31st year-end boundary.
It absolutely must. If the company's accountants fail to properly calculate the expected value of that variable consideration and fail to record that liability on March 31st, they will overstate the company's profits for that financial year.
Right.
And subsequently, the next year's profits will be understated when the massive expense of the Swiss tour hits the income statement without the deferred revenue to match it. It distorts the year-over-year trend analysis, which is exactly why auditors scrutinize these boundary crossings so intensely.
So if we pull all the way back, what does this all mean? What have we actually uncovered here? We started with a hypothetical scenario that felt almost, playful. A billboard-style marketing pitch. Buy our heavy machinery, get a solid gold coin, and we'll fly you to the Alps. To a casual observer, it's just a cost of doing business.
But by running it through the Ind AS 115 blueprint, we revealed an intensely complex, multi-layered modeling exercise. We had to define the exact boundaries of a distinct promise. We had to use empirical behavioral data to statistically calculate the expected value of conditional reward.
Yeah.
We had to find market standalone selling prices to allocate that value. And finally, we had to execute a sequence of journal entries that perfectly tracked the transfer of control, the extinguishment of liabilities, and the self-correcting realization of breakage.
It completely shatters the idea that accounting is just backwards-looking bookkeeping. It's a predictive modeling. Which leads me to a really fascinating thought about where this is all heading.
Yes, the future of revenue recognition is going to test these frameworks to their absolute limits. Today, we mapped out the rules for physical machinery, physical gold, and physical plane tickets. But look at where modern marketing is going. We are seeing the explosive rise of digital rewards. Companies are offering proprietary crypto tokens, exclusive NFTs, digital skins in video games, and massively complex multi-tiered digital loyalty ecosystems.
Right. And the fascinating thing about digital rewards is that the marginal cost for the company to produce one more digital badge or one more NFT is essentially zero. But the perceived value to the customer, and therefore the standalone selling price, can be wildly volatile.
Exactly. How does an auditor verify the standalone selling price of a unique digital asset that only exists within a company's proprietary app? Furthermore, as these incentive ecosystems become more complex, calculating that empirical probability, the expected value method we discussed, is moving far beyond basic spreadsheets.
Oh, I bet.
Companies are deploying advanced AI models and predictive algorithms to analyze millions of microbehaviors to estimate breakage and claim rates.
So the shadows on the X-ray are getting more complex. We're moving away from accounting for physical widgets and moving toward accounting for AI-predicted human digital behavior. The core principles of Ind AS 115 will hold, but the math required to satisfy them is going to become staggeringly complex.
It will require accountants to understand data science as well as they understand debits and credits.
That is an incredible final thought to leave our listeners with. Now, if you found today's exploration as illuminating as I did, I have to reveal exactly where this masterclass in accounting mechanics came from. We didn't invent this scenario.
No, we did not. And the source is an indispensable resource for anyone operating in this space.
The specific issue we broke down today, the intricate mechanics of the Golden Tour incentive scheme, was pulled directly from the massive issue repository on gapadvisors.com. That is GAA advisors.com.
It is an absolute goldmine. The site hosts an incredible archive of over 4,500, yes, 4,500 plus issues and highly detailed responses covering both Ind AS and Indian GAAP. It is a library of real-world, complex application scenarios.
And the most incredible part is access. Any person can register on the site for completely free. And once you are registered, you can actually submit your own incredibly specific tangled issues on Ind AS and Indian GAAP. You submit the issue, and you will receive a detailed, authoritative response delivered directly to the inbox of the email you registered with.
If you are an auditor, the value of that cannot be overstated. When you are staring down a massive, messy revenue contract and you need bulletproof documentation on exactly how to address the application of an Ind AS paragraph, having access to an archive of over 4,500 resolved issues is essentially an auditing superpower.
It's an essential toolkit. Furthermore, the specific scenario we discussed today was prominently featured in the 212th edition of the GAAP Advisors Task Weekly newsletter. This incredible newsletter is authored by C.A. Manish C. Iyer, the director of GAAP Advisors, and it is published directly on LinkedIn.
The Task Weekly newsletter is phenomenal. They have published over 230 editions to date. Think about the relentless commitment to professional education that requires. Over 230 detailed explorations of accounting reality.
If you are a listener who is registered on LinkedIn, stop what you're doing right now. Search for C.A. Manish C. Iyer or search for the GAAP Advisors Task Weekly newsletter and hit subscribe. It is completely free, and reading it every week will keep you sharper and more informed than your peers.
And if you are listening to this and you find yourself facing an incredibly specific, high-stakes hurdle regarding Ind AS or IFRS, maybe a contract even more convoluted than the one we explored today, you do not have to tackle it alone in the dark. You can actually book a one-on-one consultation directly with the author, C.A. Manish C. Iyer. You can find his booking page easily on topmate.io. It is an invaluable opportunity to get expert eyes on your specific framework challenges.
Amazing resources for anyone looking to master these frameworks. Whoa, we have covered an immense amount of ground today, untangling the mechanics of variable consideration and expected value. I want to sincerely thank the audience for your time. Your time is incredibly valuable, and choosing to spend it diving deep into the structural reality of financial reporting with us means the world.
We echo that gratitude entirely, and we have a small request for you before we go. Knowledge of this depth is most valuable when it is shared. Please share this deep dive among your contacts, your colleagues, your audit teams, and your finance departments.
And a massive special shout out to the students listening.
Absolutely. If you know students currently pursuing their CA course, please share this with them. The conceptual understanding we walked through today, moving past the rote memorization of paragraph numbers and truly understanding the mechanisms of control and expected value, is exactly what bridges the gap between textbook theory and actually passing those rigorous exams. Help us spread this critical knowledge on the application of Indian accounting standards.
Yes, drop the link in your CA study groups. And finally, please follow or subscribe to the GAAP Advisors Ind AS Clinic Deep Dives. You can find us on Spotify, on Amazon Music, or on YouTube, whichever platform you prefer to listen to your GAAP Advisors Ind AS Clinic Deep Dives on. Hit that follow button so you never miss an exploration.
It is the best way to ensure you are always ready to interpret those shadows on the financial scan.
Exactly. Because as we've seen today, the X-ray might not show a clean break, but if you understand the framework, you can always find the truth underneath. Keep learning, keep questioning the numbers, and we'll catch you on the next deep dive.